In a few days, the financial press expects a routine changing of the guard at the Federal Reserve. The current chairman is scheduled to pack up his office, hand over the gavel, and walk out the door. But Jerome Powell is breaking a 78-year tradition. His term as chair ends on May 15th, but he is using a legal loophole to keep his voting seat as a regular governor through January of 2028. This decision follows a public confirmation hearing where his successor, Kevin Warsh, promised the United States Senate a regime change in the framework used to value the U.S. dollar. Powell is using his remaining seat to anchor the Federal Reserve against the very political influence he spent the last 2 years fighting. Staying on the board ensures he keeps a vote and a voice over the currency's future. The pressure for a takeover has been building for years.
Powell has navigated a president who spent 2 years trying to fire him, a DOJ probe into building renovations used as a removal pretext, and a Treasury Secretary demanding absolute loyalty. The institution is fracturing. At the most recent policy meeting, 4 committee members voted against the chair, the most dissenting votes since 1992. To understand the gravity of this modern standoff, we have to look at the only 2 times in American history this exact scenario played out. In 1951, Mariner Eccles became the last Fed chair to refuse to leave his board seat after being ousted. President Harry Truman wanted the Fed to hold interest rates artificially low to help finance the Korean War, even though inflation was already running at 21%. That act of insurgency produced the 1951 Treasury Fed Accord, a firewall, legally separating political election cycles from the Fed's control over the money supply. By holding on to his seat and his vote, Eccles successfully defended that firewall, leading to 7 decades of relative dollar stability. The alternative playbook arrived in 1970. Richard Nixon wanted cheap money to boost the economy before his re-election, so he installed a loyalist named Arthur Burns to run the Fed. Burns abandoned the firewall and handed Nixon the liquidity he wanted, stimulating the economy just in time for the 1972 campaign. This chart shows the cost of that. Inflation was 5% when Burns walked in. By 1980, it had climbed to 13.5%, a number that decimated the purchasing power of the middle class. Satyrs who followed the rules and kept cash in the bank were destroyed. By the end of the decade, the dollars sitting in their accounts bought less than half the value they started with. While cash savers watched their solvency evaporate, real estate operators used the same inflation to shrink their mortgages, massive fortunes as asset prices and rents soared. Powell is staying in the building because he recognizes this pattern, attempting to execute the exact 1951 defense to keep his successor from repeating the 1970 disaster. We don't have to guess if this transition is a risk. We can see how the world's most sophisticated investors are positioning their capital right now. A recent J.P. Morgan report covering 333 families with an average net worth $6 billion shows that these elites view inflation and interest rates as their single greatest portfolio risk. As this chart illustrates, these families are moving 60% of their money out of the dollar and into alternatives like real estate and commodities. While retail advisors often tell average Americans to stay the course, the institutional elites are already executing a 1970s-style survival strategy. If the Fed's independence breaks, leaving your money in a low-yield savings account guarantees a loss of purchasing power as the currency is devalued. You have a narrow window the political transition completes. The first step is rescuing your cash by moving it into a high-yield account paying at least 4% to stop the immediate bleeding. The second move is defensive structuring, converting a portion of your liquid assets into physical precious metals as a hedge against a politicized dollar. The third is strategic offense. Like the family offices, you can use fixed-rate debt to acquire cash-flowing rental real estate before underwriting rules tighten. Pick at least one of these paths this week. The transition begins on May 15th, and the rules of the system are about to change. The firewall protecting your money is currently fracturing. Waiting for politicians to save the dollar's value will only guarantee your savings go down with it.